Okay, hello everybody and welcome to another set of videos. We're switching topics and moving on to credit risk topics, which start with with a lesson or a section named the sources of credit risk. So we're going to discuss credit risk in a more theoretical way, but also introduce some numerical concepts that may be tested in a quantitative way. Right, so what's credit risk all about? You kind of intuitively know this. I think everybody knows it. It's the risk that a borrower, in cases of loans, or maybe an issuer in the case of debt securities, fails to meet the promised payments, be they interest or principal payments. Obviously, those would be stipulated under a bond contract, how much they should be and at what time they should be paid. And of course, if somebody doesn't pay, they enter what we technically term default. So a lot of the time we'll be talking about either default risk or perhaps credit risk. Default is the failure to make a scheduled payment on time or in full. The way your book discusses this, the way the curriculum discusses this, is by first of all focusing on different factors that may influence credit risk or may contribute to it, and those are those credit risk factors, or credit risk, let's say, depends on, that's a good way to put it, both factors that are inherent, internal, and specific to the issuer. Depends on borrower-specific factors or issuer-specific factors. Okay, that's one. And the other is certain general economic factors. And the idea behind those is they should at least influence pretty much all borrowers and all issuers in the economy in a given country or zone of operation. Okay, and this is a good place to actually introduce what the book describes as the C's of credit. The C's of credit, which I'm going to write down over here, are a way of thinking about credit risk, or the sources of credit risk, both borrower specific as well as general economic factors, in terms of words or phrases that begin with the letter C. So let's think about first the general economic factors, because those are drawn at the top, at least in your curriculum, when it comes to presenting this framework. So these are the so-called top-down factors, which influence issuers or borrowers from the top down to the specific issuers, and there are just three of those. They are conditions. The second one is country, and the third one is currency. Right, so when we say conditions, we simply mean general, let's say, economic conditions. And these are absolutely faced by all the borrowers, so everybody who does business in a given, let's say, economy is influenced by its good or bad performance overall. Now, when it comes to country, what's meant by this is the geopolitical situation, less than the economic one. Think about conflicts, wars between in specific areas of the world. The quality of the legal stroke political system in a given country. That's going to be very important here as well. And when it comes to currency, this is the effect of foreign exchange movements, fluctuation. Now, not all borrowers will be affected by this, that's for sure. Not everybody is exposed to currency movements, not everybody is an exporter or importer, or perhaps borrows in a foreign currency. So, these three nevertheless are the so-called top-down factors, which are representative of the influence of general economic conditions. Now, onto the more extensive list of the so-called borrower-specific factors. These are going to be described as the bottom-up factors. And there are more of them. There are, in fact, 5 of them. The first one, I'm going to write the names down first and then describe or discuss each one in turn. The first one is called capacity. The second one is capital. And I'm trying to sort of make room for each one to write a little bit about each one. The third one is going to be collateral, and then followed up with covenants, and finally character. Okay, so five lines here, 5 factors. Let me stress that all of these the ones that I'm drawing at the bottom here, so at the top I had the top-down factors, and now I'm making clear separation from the so-called bottom-up factors. Okay, let's start on the left-hand side with capacity. Well, this is the ability of the borrower to actually make debt payments on time, to make the scheduled debt payments on time. Okay, that's capacity. Can they do it? Capital relates to potentially other resources that a company may have, which may reduce its reliance on debt. So other company resources which can reduce its reliance on debt. Maybe some assets which could be sold off and potentially therefore provide additional funding, and as a result reduce the need to borrow additional money. Okay, or maybe the ability to get money from an equity investor. That's also potentially possible. Right, sorry, didn't want to cross that one out, but I do seem to repeat that mistake quite a lot. I wanted to highlight once again in this orangey color the next one, which is collateral. And this is the quality as well as the value, of course, of the assets that have been put up as collateral. Value of assets which are supposed to support the debt, supporting the debt. That's the collateral. Okay. Now, fourth one, covenants. I guess pretty clear, this one, right? The legal terms. Which the borrower stroke issuer in the case of bonds must comply with, once again, pretty straightforward. This whole framework has been sort of made up so as to have the letter C appearing in all of these points. So by definition, it is a little bit sort of, let's say, it is a little bit artificial. We could create much better names for these specific factors, but we have to. So somebody decided it would be good to have the letter C appearing in all of them. And the final one is character, and this is actually one which I very strongly believe with. You may have capacity, you may have, capital, collateral, etc., etc., but character is absolutely key, and that's the quality of management in a company, because we are here realistically talking about corporate borrowing, borrowing by businesses. What is the quality of the management and their willingness to pay? If you lend money to somebody, character describes primarily the willingness of that somebody to pay you back. And that's an extremely important characteristic from somebody who used to work for a bank for a very long period of time. Now, some of the characteristics which we described here under the bottom-up factors would be described as quantitative. For example, this one, it's a quantitative factor, capacity, quantitative. This is something we can calculate using financial ratios and try to express in terms of a number. The same with capital, that's very quantitative. Now with collateral, because we are talking about quality, value as well, but quality first, your curriculum describes this as more of a qualitative factor. Qualitative, okay. Covenants also qualitative. I know covenants can sometimes, and a lot of the time, are expressed in terms of financial metrics. Your net debt to EBITDA ratio should not go to a certain level, beyond a certain level. Yeah, but a lot of the time covenants just prohibit you from doing certain things, and they are qualitative. And character for sure is a qualitative characteristic or a qualitative factor. Okay, good. Well, this is the way your curriculum thinks about it. So have a look at these 3 so-called top-down factors, 5 bottom-up factors, all of them very important, all of them factors you should be aware of, with the exception of currency, which may not impact everybody. All the other factors are absolutely relevant to issuers and borrowers, irrespective of their size and scale. Okay, let's now think about the sources of repayment, sources of debt repayment. Meaning, when a company, and we will be focusing primarily on companies, but not only, we'll talk a little bit, at least for now, in this beginning introductory lesson, also about sovereign issuers. Where does the money, where does the cash flow come from? Where does it come from? What is its source? Okay, well, I think I talked about this in the past, but when it comes to unsecured bonds, obviously these would be bonds issued by companies of an unsecured nature. You're really looking at operating cash flows. CFs here means cash flows. In the case of, I should have used the color black here, secured bonds, well, we've essentially got 2 sources, the primary one being, once again, operating cash flows of the company, but there is a secondary source in the form of proceeds from the sale of collateral. Which will also be potentially used to meet creditor claims. And finally, sovereign bonds. Well, in the case of sovereign bonds, it's primarily the revenue obtained from taxation, so tax revenue. That's the primary resource used or source used to make debt repayments. Okay, and a very important note here, which your curriculum states: if a borrower or issuer of bonds, right? Those terms are absolutely synonymous in this context, is unable to meet a debt payment. In other words, they're not able to make a debt payment on time, debt payment, because they've got insufficient resources. We would describe them as being illiquid, which is obviously the opposite of being liquid. Illiquid, that borrower is illiquid. Okay, but please differentiate this from an insolvent borrower. So this is an illiquid borrower. However, an insolvent borrower would be one who possesses assets that are lower than their liabilities. And you see, this is a big difference, because sometimes you may have insolvent borrowers who are still able to get the cash resources to stay current on their debt. However, they may be at the same time insolvent in the sense of the value of their assets being lower than the value of their liabilities. And the other way around as well, you may have illiquid borrowers who cannot make the upcoming debt payment, be it interest or principal, even though they may still be solvent. Assets are higher than liabilities. It's just the case that those assets are not very liquid. They may be frozen up in stuff that is difficult to liquidate, stuff that is difficult to sell, and it's important to be able to make that distinction. Okay, well, if we take it a little bit further in terms of these sources of debt repayment, let's just say that for corporations, that is for corporate borrowers, the primary, so the very sort of essential first cash flow generation source would be their day-to-day business operations, as well as perhaps some investment activities. Now, your book does mention financing activities, although I don't necessarily agree with this, because I think financing activities is something of a secondary source. So that's primary. Secondary, cash flow generation sources. Where can you get cash from to pay off your debt? If the primary sources in some way fail, well, you can do some asset sales. Okay, if you think about a cash flow statement, asset sales would qualify as an investment activity cash flow. But when I said investment activities here, I meant more things like dividends received from perhaps subsidiaries, or maybe interest received on deposits, that kind of thing, more sort of business as usual, as opposed to asset sales, or perhaps divestitures, which is when you sell a bigger part of a business, or indeed a whole company that was part of your group. And financing activities would be things like issuing additional debt. Well, that can bring, of course, fresh cash into the company, and so can issuing additional equity. But that's definitely under financing activities when you think about it from a classic cash flow classification point of view. So I wouldn't really put them under primary cash flow generation sources. For me, those are secondary, but be aware that your book says, well, over here, investment activities plus, I'm going to put it in bracket, financing activities as well, although I'm not really in total agreement with this on a personal level. But at the end of the day, it's what's in the curriculum that counts, not what I think. Okay, what about sovereign issuers? Sovereign issuers, so not corporations, sovereign issuers. Here it will of course be, in terms of primary cash flow generation sources, okay, let's put an S at the end here. It will be taxation, it will be taxes. Those could be income taxes, corporate plus individual income taxes, absolutely. They could be VAT, value added tax, sales tax, depending on where you live, different forms of that taxation come about. Capital gains taxes, something that we explore a lot in financial markets and investing. Wealth taxes, there's a whole host of taxes, inheritance taxes, etc. There will also be, associated with imports, tariffs, various fees, and so on. In terms of secondary cash flow generation sources, of course, governments are able to pay off debts because they also issue new debt. So once again, issuing new debt, borrowing additional money, but also privatization, selling off state-owned assets, perhaps state-owned companies. That's often a way to get your hands on fresh money if you're a government. Right, now to the very important topic of how we measure credit risk. We talked about the sources, let's now measure. So measuring credit risk. Okay, well, you need to be aware of a certain framework that we use, which focuses on the idea of expected loss, abbreviated as EL. This is defined as the probability weighted. No, that already sounds a little bit sophisticated and scary, I guess. It's the probability weighted shortfall, in other words, loss for a given period. Now I'm going to give you the framework to think about this, and please be aware that in the relevant reading in the curriculum, in your learning ecosystem, you're going to see plenty of examples of this, plenty of questions to explore this, and every time you come across a question, just apply the framework that I'm going to present here, and it should be absolutely fine. So EL, expected loss, is defined as the POD, standing for probability of default, times LGD, which stands for loss given default. Let's write these out separately. So we've got the probability of default on the left hand side. That is the, well, essentially, as the name suggests, I guess, the likelihood that the issuer will default. Will default. That is, get into trouble. They will default. That they will fail to make the required payment, be it interest or principal, to make a payment on time or in full. either situation leads to a default. So that's one part of the formula. The second part is this thing called the loss given default. LGD, loss given default. And this is very simply the loss to the investor if a default, that is a failure to make a payment, happens, if it occurs. Okay. Now, LGD itself can be written out into something a little bit more elaborate. So, unfortunately, one more thing to remember here. It's the EE times 1 minus RR. Now, EE stands for expected exposure. Let me bring this up. Expected exposure. Alright, so okay, let's take it back to basics for a moment. We're thinking about once again I crossed it out, I didn't mean to. We're thinking about how much on an expected probability weighted basis we may lose. What's going to be the shortfall? Well, on the one hand, it's a function of how likely it is that trouble may occur, a default may occur. But if it does happen, what will be the loss that we will suffer? And an absolutely critical element of that thinking is, well, what's going to be our exposure when such a default happens? Meaning, how much will the borrower likely be owing us? This is also known as the EAD, that's exposure at default. And of course, if the borrower has already paid us back a large chunk of what they had previously borrowed, that's not going to be such a problem as if they hadn't paid us anything. So this is basically the size of the investor's claim, of the creditors. The creditor is who's providing the funding, or in the case of bonds, we can just simply say investor's claim. How much the other side owes me as a creditor. Now, the other term, 1 minus RR, that RR stands for the recovery rate, because even if that other person owes you quite a lot of money, well, there may still be not such a small chance of recovering a big portion of that money. So this relates to the idea of loss severity. Loss severity. It's the unrecovered portion of the claim. So over here we had claim. How much of that are you not going to be able to recover? Because typically the recovery rate is higher than 0. We do recover something even if a borrower does indeed default. Now, very importantly, if you invest in bonds, you should expect to receive adequate compensation for the risk that you face. So, adequate, or let's say fair compensation for that credit risk being faced means that you will expect to receive a yield containing a credit spread, a spread above the yield at which you would be happy to lend to a risk-free entity like a government. And that credit spread should more or less, that didn't come out right, but I wanted to do a bit of a wave to show more or less equal to the probability of default. Let's do this, make this into a proper P. times the loss given default, obviously expressed as percentages here. We should expect more or less that level, and please have a look at the questions in your curriculum. They're quite good at exploring this. You'll see how they test whether you can appropriately judge whether a given bond issue is actually giving the investor the adequate level of compensation given the risk posed. They're not complicated, they're very simple. I'm not going to write them out or do similar questions. They're just too simple in my opinion, but please have a look to see. And from this comes the idea of the G spread, which I'll be doing a video on quite soon. That's the spread over, in terms of the yield, how much yield or compensation an investor should require over the government bond yield. What they require from a bond where the government is the issuer, the government bond yield. Okay, so as I said, please be prepared for simple questions exploring these relationships mathematically. They shouldn't really cause you any trouble, at least I don't think so. Now, just to finish off, let's think about some of the factors influencing credit risk. In terms of the POD and the LGD, because I said credit risk before, so maybe let's make this more specific. POD and LGD, we've introduced these terms, so let's now use them consistently. Well, the first one I'm going to start with is the POD, and let's think about what makes the probability of default go down, potentially. First of all, well, your book mentions 3 factors. Everybody could have potentially their own ideas on this, but your book does essentially mention 3 things, and I think they're pretty obvious in the sense nobody's going to ask you probably to list them, but if they show up, just be conscious of the direction or the effect they have on the probability of default. The first one is the issuers. We're talking about a corporate issuer, I guess. Issuers' profitability. And of course, if an issuer is able to generate stable, so this is profitability, if an issuer is able to generate stable, predictable profits, and also hopefully cash flows as well. Profits are not the same as cash flows, but cash flows is the money that pays debt or repays debt. That's brilliant. Of course, better profitability means a lower probability of default. So this goes in tandem with a lowering of the probability of default. And your book does, I'm not sure if it's really needed, talk about the way in which profitability may be measured in this context. So measured by, for example, the EBIT margin, how much money is, or what margin is left after covering a company's operating expenses, but before things like interest and taxation. Okay, so that's one, issuer's profitability. The second is a little bit more complicated. It's called coverage, and this is basically checking whether we have enough cash flows to cover our interest expenses, cash flows or profits to cover interest related expenses. So most of the time the way we're going to be measuring this by, e.g., ratios like EBIT, earnings before interest and taxes, divided by interest expense, to show how much our EBIT, our earnings before interest, and of course taxes as well, is able to cover our ongoing interest expense. And there are, however, other more sophisticated coverage ratios used in banking, like the debt service coverage ratio, the DSCR, which your book doesn't talk about here, but perhaps it should. And, oh, sorry, a bit of a zoom here, unwanted zoom here. Where are we? Okay, the final one is going to be leverage ratios. So we've got profitability, coverage, and leverage. This is the relative, a measure of the relative reliance of a company on debt funding. So these will, for example, be measured by measures such as, for example, debt to EBITDA, or perhaps cash flow to net debt, things like that, which you also learn about in the financial statements analysis of the curriculum. You don't have to really remember these things. I'm just throwing them in because your book does mention these examples, but I would be very surprised if anybody examined you on this. What I think is really important is just the relationships. We know that better profitability, higher profitability leads to a lower probability of default. Now, if your cash flows or profits cover interest expenses by a higher factor, that's also better. So having a better coverage also leads to a lower probability of default. However, in the case of leverage, the more debt you've got potentially, well, the more levered you are, the worse that is going to be in terms of probability of default. So here leverage does not contribute to a better probability of default, rather the opposite, quite obviously. And we said we would also touch on loss given default, LGD measures. This is more a function, so LGD is definitely more a function not of the issuer's current condition, but a function of the nature and the seniority of the specific claim, specific debt claim held by that specific lender or investor. And we know that some of those claims may be more senior, others may be more of a junior nature. So, for example, if the claim is unsecured, then of course, the LGD, loss given default, will go up. That may not mean the probability of default goes up, because that is very, dependent on the situation of the issuer currently. But the loss given default, if a default happens, will definitely go up. Right, that's pretty much it for this video. In the next one, we're going to explore credit ratings and the work of credit rating agencies.